Enron was the most admired company in America. Then it vanished in weeks. $90 a share, gone to zero in months. 20,000 workers lost their jobs and their retirements. Their pensions were tied to the very stock that collapsed, and the men at the top went to federal prison. By the end, you will spot this fraud before it ruins you, because one number on one statement told the whole truth early. Let me show you the number Wall Street ignored. Enron began as a boring pipeline company in Texas. It moved natural gas through thousands of miles of pipe. In Houston, a young executive had bigger ambitions. Jeff Skilling wanted Enron to trade energy like stocks. He turned a pipeline firm into a giant trading desk. Enron became a market maker for electricity and gas. On paper, the growth looked absolutely spectacular. Revenue exploded from billions into the 100 billions. Wall Street fell in love with the story. Magazines named Enron the most innovative company in America. For 6 straight years, it won that very title. But the profits underneath the story were largely an illusion. Here is the first trick, and it is the big one. It is called mark-to-market accounting. Normally, a company books profit when cash actually arrives. Mark-to-market lets you book profit you only expect to earn. Say Enron signs a 20-year deal to sell gas. It estimates every future dollar that deal might bring. Then it books all those future profits today. At once, picture sand running through your fingers before you hold it. The cash had not arrived and might never arrive, but the income statement showed glittering growing profits. Enron got to guess its own future, then book the guess. And every guess was conveniently optimistic. Feel how dangerous that freedom is for a moment. If you can invent your profits, you can invent anything. Now here is the second trick, even darker than the first. Enron had real costs, real debts, and real failures. Bad investments that lost real money piled up quietly. Those losses would have wrecked the beautiful story. So Enron needed somewhere to hide the ugly numbers. Enter the chief financial officer, Andrew Fastow. Fastow built hundreds of secret partnership companies. These were called special purpose entities. On paper, they were separate, independent businesses. In truth, they were Enron wearing a paper mask. Enron shoved its debts into these hidden entities. It parked its failing investments there too. So the debts simply disappeared from Enron's own books. The company looked lean, profitable, and almost magical. Some partnerships were even named after Star Wars characters. Fastow secretly earned millions running them himself. He was on both sides of nearly every deal. This was a staggering conflict of interest, and the board of directors waved it through. Now think about who was supposed to catch all this. Every public company hires an outside auditor. The auditor is meant to verify the numbers are honest. Enron's auditor was the famous firm Arthur Andersen. Andersen earned huge fees from Enron every single year. It earned even more selling Enron consulting advice. So the watchdog was being paid by the thief. When trouble came, Andersen did something unforgivable. It shredded tons of Enron documents and emails. They destroyed the very evidence investors needed. Hold that image, because it is the whole rotten system. Now, where were the warning signs an investor could see? This is the part that can actually protect your money. Every company files an income statement showing profit, and every company files a cash flow statement too. Profit can be shaped by guesses and clever choices. Cash is the actual money moving in and out the door. Earnings are an opinion. Cash is a hard fact. Enron reported enormous, beautiful, rising profits, but its cash flow told a completely different story. The company was bleeding real cash year after year. Profits went up while actual cash drained away. That gap is the single loudest alarm in investing. When reported profit and real cash split apart, beware. Honest profit eventually shows up as honest cash. Fake profit never does, because there is no cash behind it. So here is your first usable skill. Write it down. Read the cash flow statement, not just the earnings. Ask one question. Is profit turning into cash? If profit climbs but cash does not follow, stop. That single habit would have saved thousands of people. Now here is the second skill, and it is just as powerful. Distrust any business you genuinely cannot understand. Enron's own annual report was nearly impossible to read. Smart professional analysts could not explain how it made money. When asked plainly, executives gave fog instead of answers. Warren Buffett built his fortune on a simple rule. He only buys businesses he can fully understand. If you cannot explain how a company earns its money, you do not own an investment, you own a hope. Complexity is not a sign of genius. It is often a hiding place. Honest businesses can usually be explained on one page. Fraud hides inside footnotes, jargon, and clever structures. So if it is too complex to follow, walk away. Your ignorance is the con artist's best friend. Now watch how fast the whole tower actually fell. By 2001, the questions finally grew too loud. A few brave journalists asked the simple question, how exactly does Enron make its money? No one inside could give a straight, honest answer. The hidden partnerships began to surface, one by one. Suddenly, billions in buried debt came into the light. Enron was forced to admit its profits were overstated. It restated years of earnings almost overnight. Confidence shattered and the stock began to freefall. $90, then $30, then $10, then $1. Picture an employee watching their savings evaporate. They were forbidden from selling as the stock crashed. Meanwhile, the executives had quietly sold their own shares. In December 2001, Enron filed for bankruptcy. It was the largest corporate bankruptcy of its time. 40,000 jobs across the world were wiped out. Retirement accounts built over decades simply vanished. Now the law finally came for the men at the top. Andrew Fastow admitted his fraud and went to prison. Jeff Skilling was convicted and sent away for years. Ken Lay, the founder, was convicted as well. He died of a heart attack before his sentencing. And Arthur Andersen, the great auditor, was destroyed. A firm of 80,000 people simply ceased to exist. The fallout reached every investor in America. New laws were written to force honest reporting. But laws always arrive after the money is already gone. That is why your own judgment must come first. So let us gather the lessons into tools you keep. Lesson 1. Earnings can be faked. Cash is far harder. Always read the cash flow statement before you invest. Check whether rising profits bring rising cash with them. Lesson 2. If you cannot understand it, do not own it. Demand a plain explanation of how the money is made. If the answer is fog, that fog is your answer. Lesson 3. Complexity is a warning, not a badge. The more tangled the structure, the more you must doubt it. Honest companies want you to understand them clearly. Frauds need you confused, so you keep handing over money. Now notice how simple these 3 rules really are. They do not require a finance degree to use. They require patience and a refusal to be dazzled. Enron dazzled everyone, and everyone paid the price. The crowd cheered the story right up to the collapse. The quiet investor who read the cash flow stayed safe. Be that quiet investor every single time. Money loves a good story, but it lives on cash. Stories can be written by anyone who wants your money. Cash either showed up or it did not. So, before the next exciting company tempts you, turn past the headline and find the cash flow page. Read it slowly and let the truth settle in. The most admired company in America died of fake profits. Real cash, honestly earned, is the only thing that lasts. If this was useful, the next episode covers margin of safety. Read the cash, doubt the fog, keep what you earn.